This lesson is focused on building a well-balanced, low-risk, high-return crypto portfolio. What you'll learn is how to reduce risk and volatility in your portfolio, the difference between asset allocation and diversification, how to rebalance your portfolio, crypto taxonomy, and the pros and cons of concentrated versus diversified portfolios. Let's start with what a typical crypto portfolio looks like. These numbers are theoretical, but this would be a great ratio to use if you are a beginner. You'll notice that 70% of this theoretical portfolio is weighted with low-risk assets such as Bitcoin and stablecoins, with 30% allocated to what would be considered medium to high-risk assets, altcoins, NFTs, or various tokens. These numbers can vary greatly depending on the type of investor you are. If you have a high risk tolerance, then you're more probably into altcoins or NFTs, and your portfolio might be diversified differently. Whichever way you decide to go, always keep in mind the potential volatility of your asset and how it might affect your portfolio. With NFT investors, the metrics change even more. In most cases, NFTs are ranked by their rarity or utility. So your portfolio might be weighted more so by well-established brands or NFTs with a strong user base. There's a portion of this lesson where we will go into how to identify what high-risk, medium, and low-risk assets are in more detail. One very important fact to know when selecting tokens and coins is the difference between the two. Coins are native to a particular blockchain. For example, a Bitcoin is native to the Bitcoin network. Ethereum is a coin native to the Ethereum network. Ethereum issues tokens in the form of ERC20. These are assets like Decentraland, Gala Games, and Harmony One. Anywhere you see the ERC20 identifier, that is how you would know the difference. The reason you need to be aware of this is that they do not operate the same or offer the same incentives. Coins are a bit superior in the sense that they can produce tokens to add to their utility. As we mentioned a moment ago, Ethereum is the best example of this, but other coins are doing this as well by establishing token standards. Token standards are simply coded identifiers that blockchains use to connect that token with its respective blockchain. The RC in ERC20 stands for request for comment, meaning requesting permission to verify that the token belongs to that particular chain. When you see this on other chains, it will often lead with the first letter of that coin's ticker symbol, followed by RC20, 721, or for NFTs, 1155 and 777 for smart contracts or very specific uses. Again, these are important to know when selecting coins or tokens because it gives you an idea of how they could be adopted. Now let's talk about asset allocation versus diversification. Asset allocation refers to investing in different asset classes such as crypto, stocks, bonds, or precious metals at the same time. Diversification relates to the distribution of your investments across multiple assets within the same sector. Asset allocation is typically done by larger institutions. For the everyday investor like you and me, diversification would suit us best. With diversification, you can better reduce overall risk and volatility. Losses can be offset by gains and keep your position stable over time. However, if you over-diversify, be aware that your portfolio will track closer to the overall performance of the market, meaning if we are in a bear market, so is your portfolio. A concentrated portfolio centered around 1 to 3 tokens will lower your exposure to the performance of the overall markets, but can be constricted to the fate of 1 or 2 assets. So in the event that one of those assets don't do well, it means the performance of your portfolio suffers too. Concentrated versus diversified depends on the individual investor preference. Both strategies will reduce risk, so for a beginner, finding a balance between the two would be the best idea. An easy way to do this would be to concentrate on one sector and diversify into that. Metaverse coins are still very popular right now, and their use case has not yet been proven, but anticipation is everywhere. In this sense, you could concentrate on positions in the biggest metaverses, Decentraland, Sandbox, and Axie Infinity. Then you could slowly diversify into smaller, less established brands, always with the intention to mitigate risk by leaning on the best performing assets. Next, we're going to go into crypto taxonomy, or the types of coins that you hold. For these 4 categories, they can both apply to tokens and coins. They are payments, stablecoins, utility, and governance. Payment coins are primarily used in transactions for goods or services. Popular payment coins would be XRP, XLM, XDC, and Algorand. Stablecoins represent fiat or digital dollars. When it comes to stablecoins, consider them as the base of your portfolio, money that is available to you to move in and out of the market quickly. USDC, USD Tether, and Binance USD are some popular stablecoins that are available on most exchanges. Then we have utility coins that are required for any activity on a particular network. Binance, Ethereum, and Hedera Hashgraph are smart contract platforms that require the use of their token for various network activities. Lastly, we have governance or voting power for a particular network. This category is more new to the space, as protocols are just now starting to expand governance to individual coin holders. This leads us into portfolio psychology. Here is when we will go into how to diversify into high, medium, and low risk assets, and knowing when to rebalance your portfolio. Since the crypto space is still very young, don't be afraid to move money around when necessary. In my first bull market, I did not have a clue what I was doing, but now that I am going into my 3rd year of crypto, I plan to implement what I have learned thus far, which leads me into the HRMD strategy. With this methodology, if one of your high-risk assets rallies instead of cashing out your gains right away, consider moving those profits into a medium-risk asset or a low-risk one. This is how you can preserve the gains you have made during a bull run or even in a bear market. High-risk assets would include meme coins or fairly new projects without a proven track record. Medium-risk assets will have just recently fallen from an all-time high, have good utility, but not enough publicity to keep them always in the conversation. Even if you have done the research and know with certainty about the validity of a particular project, if the market at large does not accept it, it will be harder to gain traction and subsequently price movement. Then we have low-risk assets, which include Bitcoin, stablecoins, and other coins with a long-standing reputation. They've been here since the beginning and continue to develop and contribute to the crypto space. For this type of strategy to work effectively, you must always do your own research. Becoming self-educated in crypto now will put you years ahead of your peers when the mainstream bull run begins. Here's a list of resources that top crypto analysts in the space use to get the best real-time crypto data. Screenshot this page so that you have it for future reference. Your goal with your portfolio is to provide a decent balance between high risk, medium, and low risk assets. Doing so will keep your portfolio above water even when everyone else is in the red. Yo, thanks for watching DHN Crypto. If you found value in this content, hit that like button and share this information with a friend. DHN official merchandise is now available. The DHN Crypto Journal and SafePal links are in the description. Have a great day, have a prosperous day, and most importantly, if that money is digital, so is the hustle. I'll see y'all in the next video.